and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to talk a little bit about loan officer compensation rules and some proposals by the Mortgage Bankers Association to these rules. Now, I spoke about this months ago. I think it was an article that I had read talking about the possibility of the CFPB kind of relooking at loan officer compensation rules. But I was in a meeting just last week. I'm part of a legal and legislative group at the Washington Mortgage Bankers Association. And we do a lot of advocacy work and stuff like that. And I was in a meeting and there was a representative from the MBA there talking about different things that the MBA is working on. And one of them is around loan officer compensation rules. And I got a lot more specifics about exactly what the MBA is proposing to the CFPB as they are openly in the planning stages of potentially reviewing and revising LO compensation rules. So I thought this was super interesting, and I think this audience might be interested in this. And there's really three main areas of loan officer compensation that they are proposing get a look and possible revision. So I'm going to walk through those one at a time. I'll tell you what the proposal is, what the framework is, and then I'll probably add in a little bit of my own color commentary and thoughts around this. I'll tell you, for me personally, I think this is well overdue. I think the loan officer compensation rules, when they went in place as part of the Dodd-Frank Act, I understand the reason why why this was included in Dodd-Frank, and I do believe that there was a lot of loan products at the time that did encourage loan officers to steer borrowers, and even companies. Whole companies were set up to sell just certain products that had very high risk aspects to them for the consumer, but also paid significantly more to the company and or the loan officer. So I understand the framework and the desire to kind of quell the steering of loans into high-risk buckets for consumers so that loan officers can make more. But let's be honest, those products, by the time Dodd-Frank was fully rolled out and implemented, most of those products were already gone, the option arms with the prepayment penalties and all that stuff. And there was so many other components of Dodd-Frank that put other rules in place that eliminated those risky features that were so valuable to the secondary market, things like prepayment penalties on these adjustable rate mortgages and things of that nature. I mean, none of that exists. So what this has created is a landscape that's just not equally competitive, let's say, across the channels, right? We all know that banks, the big banks, have certain benefits and advantages in the market because of just their size, the fact that a lot of them are lending their own funds and their cost of funds is so much cheaper, so they can choose to do things with that money that they've collected mostly from depositors that they need to lend out. They can kind of do it at whatever kind of margins they want. They're not really tied necessarily to what the valuation of those are in the secondary market. So there's some advantages there. Well, clearly there's some disadvantages. There's some things the big banks can't do, no doubt. But when it comes to this, they have an advantage. On the other end of the spectrum, you have the independent mortgage brokers. And, I don't want to rag on mortgage brokers. I think it's a very viable channel, but there's no question that the way that these rules around anti-steering and loan officer compensation have been interpreted in the broker world, leave a lot of flexibility for them to switch between lender paid and borrower paid. And essentially, there is no rules around loan officer compensation in the broker world based on direct feedback that I've had from many people that work in that environment. They can structure a loan at essentially any margin and comp that they want. And there's plenty of ways to easily structure that and meet the very low requirements, it seems, that are in place for anti-steering disclosures and things of that nature. So I don't want to do a whole conversation about that, but the bottom line is there's a lot of flexibility. And then you have the middle, which is the independent mortgage banks. And, I think there is some things that have been put in place, people trying to get creative on how they can vary loan officer compensation. But let's be honest, we're staying within a very, very tight compliance box here in order to do that. And really, it has created, this discrepancy in flexibility around margin and comp and things of that nature within our industry. So here's the proposal that the MBA has proposed. Now, some of these things, as loan officers, you're probably going to like and agree with, and some of these things you may not agree with. There's only 3 of them, so this won't take a long time. I think companies have a different perspective on this. I would say the majority of the members of the MBA, right, they're representing the larger mortgage banks within the industry, but it's not just mortgage banks, but it is the Mortgage Bankers Association. So take that for what it is, but they obviously have individual members and a lot of individual feedback as well, meaning, they're thinking about how this impacts loan officers, but also companies. So the first proposal is the most obvious one, which is lenders should be permitted to lower a loan officer's commission on a specific transaction when the loan officer voluntarily offers a concession to match a competitor's lower price, right? This is what we think about when we think about loan officer compensation rules. This is the one where clearly the way that things are operating in the broker world, they're clearly doing this on an individual loan basis. And feel free to correct me if that's not accurate, or if you don't think that that's happening in the majority of wholesale transactions that are happening in the mortgage industry today. And this is the area where I think mortgage banks have the least amount of flexibility around this. And when pricing exceptions are taken, they're often taken at the company level to allow the loan officer to be more competitive. There is some ability with new construction, with certain company-provided leads, things of this nature, where there can be some variance in the compensation. But for the most part, you're kind of, you're kind of set at one comp level for mortgage transactions, which is what was intended by loan officer compensation rules. So here's the framework. The current rigid no reduction mandate prevents active price competition and directly harms consumers. Now, again, the thought here is that if a loan officer wants to concede part of the commission to give a more competitive deal and match a competitor, that is benefiting the borrower, right? I mean, loan officer compensation rules were put in place to protect borrowers, and this is not allowing a loan officer to give a better deal to a borrower. So they, state that out. They state here the things that I just said, that this, independent mortgage banks and smaller lenders are strictly handcuffed because they cannot adjust individual loan officer compensation to match a competitive offer, reducing choices for the borrower. So that's the first one, right? The ability to simply allow a loan officer to lower their commission compliantly in order to be more competitive and win a deal. Something that happens all the time in our industry and is very easily done in the broker world, not so much in the mortgage banker world. Okay, the second one is variable compensation for specialty and affordable housing products. So put it plainly, this is allowing compensation structures that may be lower for bond loans, right? I mean, that's really what this is talking about. They're saying specialty and affordable housing products, but for the most part, we're all talking about state bond programs where the housing finance agency for that state is determining what the margin is for that loan. Oftentimes, it's significantly lower than what the standard margin might be set by the mortgage company. And it makes it tough because their rates are lower as a result of that. So more and more of this business tends to go to these bond programs which have in some states extremely low margin on them, sometimes barely more margin than what the loan officer's compensation is set at, leaving virtually no additional revenue to cover your standard operating and processing, direct origination expenses, as I would call them, or any of your branch expenses, things of that nature. I mean, the loan officer in some of these states is getting as much as 80% of the revenue available here. So it's just simply saying that if you're in a state where there's a very low revenue on these affordable housing programs, we want to offer those, but the compensation should be in line with the total revenue that that state allows, and just the ability to align that. So I'll just read you what it says here: allowing loan officer compensation to vary for specific high effort or public good loan products. This includes housing finance agency, bond loans, construction loans, specialty purpose credit programs, and down payment assistance programs. So the framework, it says, under the current rule, lenders cannot pay an LO less on a bond loan than on a standard conventional loan. However, these specialized programs require extensive administrative processing, compliance scrutiny, and carry strict fee caps imposed by the state agencies, as I was saying. Because manufacturing costs can be offset by adjusting commissions, many lenders are forced to scale back participation in these affordable housing programs as a result, which is absolutely true, right? So that was the second one, is just specific to essentially bond loans and other specialty loans. The third one, and this is where loan officers may not like this one as much, but the third area the MBA is proposing a change is around financial accountability for operational errors and violations. So in this proposal, this would allow lenders to reduce a loan officer's compensation compliantly or enforce localized clawbacks on a transaction if the LO commits a material clerical error or violates established company policy or directly triggers an early payment or default. So oftentimes, most companies have something around, EPOs or EPDs, but this just more clearly states what that policy is. Also, there's many times where mistakes might be made, and there's cures that have to happen, and those cannot be charged back to a loan officer, and they're saying that they could be. Now, I want to point out here that this one in particular is an area where I see the potential for differentiation between lenders, right? So let's just say that this went through and the CFPB allowed this. Now it's going to be up to the companies to determine, okay, under what circumstances would we dock someone's compensation or create a clawback situation? And those are the kind of things that would potentially create, different competitive advantages amongst different companies based on how they write their policies to leverage the flexibility that a change like this would allow. So this one I think is going to be interesting if it goes through, as to how different companies decide to put that in place. Because I could see loan officers going, oh, well, this company over here, if I make a mistake on a disclosure, they're going to take it out of my pay. Maybe this other company doesn't enforce that, even though technically the laws would allow you to write a compensation rule that does that. Doesn't mean everyone's going to do it equally. And that's the same with all of these, right? I mean, this is giving the freedom for the companies to leverage these different proposals if they were to be enacted, but it doesn't mean that the company that you work for is going to do that. Some may not change, right? And some may change and say, look, on bond loans, we're only going to pay 30 basis points, where maybe someone else is paying 75 and someone else is paying standard comp. You just don't know how this will be enforced, and it does leave a lot of room. But where I think it's a good thing is, look, I am a proponent of less regulation in general. I think that, we have state regulators for a reason. I think that we should let the market play out, kind of a free market kind of a concept. And I think the companies that do it really well are going to attract good producers, and they're going to attract customers. and those that don't won't have as much success, and the market will play itself out like that. So I am a fan in general of rolling back these LO compensation rules. I think the intent behind them initially was to protect consumers. I don't think any of these three areas are protecting consumers at this point with the current types of mortgages that we have available. And a matter of fact, I think there's times where a loan officer would be willing to give a customer a better deal, and they're not able to because they don't have the flexibility to do that in many cases. Or there could be the opposite situation as far as steering goes, where people are not suggesting an affordable housing loan because their company has encouraged them not to do them, or whatever the case may be, because the way that it's structured right now, there is just no profit in those loans. So if you could align compensation a little more directly with what those the total revenue on those loans is, maybe there would be less pushback from the companies that offer these. And some companies won't even do them. They just don't offer them as an option. And I don't see how that helps consumers at all. So anyways, you guys, that's all I really had today. I had spoken about this before, and I just really, since there is this clear write-up here from the MBA, I wanted to just outline specifically the three areas that they're targeting. I think there's other areas within loan officer compensation that could certainly be addressed by the CFPB. And this is not the CFPB's write-up. This is the MBA's proposal to the CFPB on the three most important areas of loan officer compensation changes that they would like to see on behalf of their members, which is essentially the independent mortgage bankers throughout this country. So I hope that was insightful for you guys. It'll be interesting to see how this plays out. I would expect something to happen here, relatively soon. This is the government, so nothing happens super quickly, but there's not a lot of time, I would say, to probably get something like this through. With the CFPB being in its current state under the current administration, et cetera. So I think the goal would be to try to get this done, in the next year or so, potentially even by the end of 2026. So two stages here. One, we got to see if the CFPB makes these changes, and then two, how do companies interpret that, and what do they actually roll out in real life to their originators? So keep an eye on this. And if you're in a position of influence and you have thoughts on this, I'd be starting to share some of those, get that feedback from your loan officers, share that with the people within the organization that make these sorts of decisions, because how this gets rolled out could absolutely cause some very happy people and maybe even some frustrated people. This can cause disruption, right, within the ranks of loan officers, depending on how these potential changes, if they get approved, how they get implemented. So keep an eye on that. You guys, this has been Market Shares. I appreciate your time and attention. We will be back with our next episode soon, so I'll see you then. Take care.